First lunch and learn of the year, or food for thought. I gotta keep conditioning myself. We've changed the name, and you got brunch, not lunch, so that didn't make sense either. But so excited to get that off and rolling. As you guys know, we'll try to do these quarterly, and try to make sure that we have some consistency. The landscape changes so fast that, as I've said before, what we talk about and what's relevant is a moving target, when we should bring in speakers and all that kind of stuff. So obviously last year was pretty heavy market stuff between the two events that I did early in the year and the two speakers we brought in. We were really focused on what was going on in the market. And so the first quarter, I think it makes sense to do some recap and try to figure out what happened in the preceding year, some of the things we may be considering in in 2023 in this case, just to give you guys some insights. So those are the major things we'll cover. The Secure Act went through again, so 2.0 has passed, and there's a lot in it, and there's not all that much that's important to you. A lot of it pertains to contributions and small businesses and all that kind of stuff that may not be important to most of you, but I'll cover a few of those. And then I think the beginning of the year is always a good time just to give you some updates if there are things changing from a company perspective, and as we grow, new folks come on board, and maybe new places that we office and all the things that we got to kind of deal with. So I want to just have a platform to be able to let you guys know about that stuff when it happens. So with that being said, I will tell you that this is a super data heavy. I know you guys know we like data. This is a pretty heavy slide deck, and I'll try to make sure, I'm not really trying to get you to get every piece of data on the slide. I want to talk through themes so that for the most part you understand the trend or the trajectory that's trying to be pointed out or discussed. In this particular case, 2022 was a really volatile year. And so what this does is this kind of goes through some of those moments that were interesting and that caused so much volatility in the year. We've talked about it before, but there wasn't a whole lot of uncertainty in the market finishing up 2021. COVID had slowed down, Omicron was here, but I think most people, based on what happened in South Africa, were thinking that that wasn't going to shut the economy down. And then we hit the year with some pretty tumultuous stuff right off the bat. The first was, they're kind of an early, let's see, there's got to be a pointer on here somewhere. I probably should have tested. There we go. So right there, inflation starts to show that it's much more than expected, and that's the first uncertainty that hits the market. You can see that later on in the year, the Fed starts to raise interest rates for the first time since 2018. So that was obviously an inflection point. Mortgage rates hit 5% for the first time, which it's so crazy to me that that's so abnormal and feels high when all of you had loans, double that at some point. So that was kind of an inflection point that everybody was paying attention to. We topped out in inflation here at about 9.1%, so that was the peak from an inflationary perspective. And then we started to see things like the inverted curve, which I'm going to talk a little bit about, the bond curve inverted. That's a big deal from a narrative standpoint, because when that happens, typically that's a lot of people believe that's a sign of an impending recession. So when that happens, that sends the markets in a bit of a tailspin. And then we closed out the year, the worst year that we've had since 2008. So a lot of stuff that went on. The cat's out of the bag for all of you about what we believe about markets. So that we think that what's happened to the markets this year because of all of those things is that the market had a tremendous amount of uncertainty, and markets don't like uncertainty, so the reactions are really quite logical and rational. So we had a year like we'd expect when we have a bunch of things like this bring so much uncertainty. I didn't point out there, but obviously the Russian invasion of Ukraine sent us with another high degree of uncertainty around the markets. So what we're looking at here is the times in the year, the number of days that the market moved plus or minus 1% in a given day. That's an indication of volatility, and this just kind of follows that same story that last year there were 114 days where the market moved more than 1% either up or down within the year. You can see the kind of relative data across the top here where that's happened before. I thought it was a little bit interesting that 2020 actually had less days. I know there was that period where the market was not just moving 1%, it was moving 5 or 6% every day. So it felt like that was a tremendously volatile year, but believe it or not, 2022 actually had more daily volatility and was more more resemblant of the periods in 2008 and 2002 where we saw a lot of daily volatility in the market. So we had a lot of uncertainty that manifested in a bunch of volatility on a daily basis and left us with some, with a lot of red up here, right? And these are the broadest asset classes. I'll talk through a number of things that kind of address asset classes today, but the broadest asset classes that we talk about are stocks, bonds, right? And then that breaks down to US, international, emerging, things like that. And so what you'll see up here at the top is just the returns for the year. So US markets ended up down about 19%. International did better. So one thing we saw from last year that we believe is a proven concept that should be executed on is diversification did provide value. And that was one of the places. That's a pretty significant delta, so quite a bit less downward pressure in developed international markets. Emerging pretty close to US. The biggest loser of the year was global real estate, not too surprising just considering what happened with interest rates and how that affects real estate. And then I would argue maybe the most impactful part of that is the bond returns. So US bonds down 13% and global bonds down about 9%. Sorry, I couldn't have my slide thing here because it wouldn't connect, so I have to look back to see what's on the slide. But so that's I think conventional wisdom to some degree is that's a really odd scenario where stocks and bonds are both down at the same time and to the level of significance. So part of the questions that we started to ask to get prepared for this presentation was how normal is that? What does that really look like? So I'm going to get to some of that later because it is hard. It's the hardest part from an investment perspective when nothing's lifting the boats, right? For a bunch of different reasons. Number one, there's nothing that provides safety that keeps the volatility off of your investments. There were a few things, commodities, which I'll talk about, but very few things that had good performance. And then two, when things go down, we want to buy more of them. But you have to ask yourself, well, what can I sell that is not at a loss already that gives me a good opportunity to buy something that's down? So that was a significant complexity of last year. I think the other important thing from this slide, I'm not sure why it's bouncing, but I apologize for that. The other important thing is stocks, going back to 2001, worst year across the board. They all were the worst in the same year. You can see here that the bond returns, the worst that we've had in both US and global markets since 2001. So really significantly bad year for bonds. You can also see that the average returns across the board, I think it's a bit surprising that, and you'll see this when I go through emerging markets a little bit later, but we did see over the past 20 years that emerging markets actually have outperformed US markets. So I just think that's interesting. Apollo actually talked a little bit about that in the last presentation because certainly recently US has been so dominant that performance and consolidation in US stocks has gotten much heavier for a lot of portfolios because just the idea that, hey, things are so much better in the US and you hear some narrative around, hey, companies are multinational, so you don't need diversification internationally as much because the companies are all over the world. But I think that was just one other surprising thing looking at that data. So when you start to break down asset classes a little further, the next thing we look at is large companies versus small companies and value companies versus growth companies. And fortunately, although all of you were down last year, unfortunately. But as you measure an advisor, you're looking for two different things. The aggregate, if I'm up or down, is obviously something that impacts everybody, but we want to set expectations that we can keep, and we hope we've never alluded to the fact that we'll be up if the market's down and we'll be very inverse of what the market is. But as you measure yourself against other professionals and benchmarks, the reason we follow the evidence from the University of Chicago is because we follow those things that have historically led to outperformance. And many of you know that value stocks are one of those areas that have been proven over the last 100 years to have outperformance relative to growth stocks. And you can see that that was pretty significant last year after a period where growth really did well. And so again, similarly, what you saw over the past bunch of years is a big consolidation into tech. A lot of people, thought that if they bought Apple and Amazon, they were really smart and nothing was ever going to happen. Obviously, we saw that pull back in a really significant way. But you can see that value stocks outperformed growth stocks by a really significant margin last year. So we actually had really good performance as a firm. And it's not, again, because we did anything different than we've done in the years before. It's because this premium of value outperforming growth really manifested in a significant way last year. One other thing that's kind of interesting here is if you come down here to the market-wide area, it again is an illustration of the benefits of diversification. One of the best performances over the past 10 years is something that's in all of those. So you do benefit from having things in different investments that are all not related and running in the same direction at the same time. Internationally, it's really the same story. You see value outperforming growth, so we saw that same premium, and so we were able to capture some of that as well. And as I said earlier, you can see that international really for a 10-year period of time has lagged pretty heavily compared to growth or compared to the US. What Apollo showed in the last presentation was that has tended to be kind of decade by decade. So we'll see, maybe the next decade would be advantageous for international stocks, but certainly last year they did a little bit better than the US on the downside protection. Emerging markets, again, same story. We saw it all the way across the board, so there was similarity everywhere where value stocks did outperform growth stocks in every category. And you also saw one of the other premiums, we call it, which is small companies outperforming large companies. So again, you guys, most of you have some recollection to the tolerance bands, the way that we trade, where when things go down, we buy more of them. When things go up, we sell off and try to take some profits. So as we look at those premiums, both value and small had benefits to the portfolio last year. Country performance, and actually I think Apollo talked about this too, but Turkey, obviously in an unfortunate circumstance now, but they were the best performer of 2022. And then you see quite a bit of similarity amongst the developed countries here on the back. The global average, the US was slightly below the global average there. Real estate, like I said, was down more than anything else. So we saw REITs suffer quite a bit. I actually have a few friends that work for REIT companies, and it's kind of a joke that there's not a whole lot of movement going on in REITs right now. So it's an interesting space. And there's the silver lining, which was commodities. We do own commodities in our portfolios through what's called MLPs. We also own some metals. And so both of those did better. Gold was still down slightly. You can see there the first one that was negative for the year, and oil and gas had the best returns of the year. MLPs were up about 16% last year, so that was helpful to having one thing that kind of lifted the boats in the portfolio. Fixed income, that's the Barclays Aggregate Bond Index. This is a measurement of bonds, and so you can see there's a few interesting takeaways from this particular chart. One is you can see that the US had kind of and really all the way across the board, you did have a standard benefit from a time standpoint where your volatility was least when you're short term. So when you buy bonds, the shorter term bonds typically are going to have less risk than the longer term bonds. You did see that manifest in every category. What you didn't see though, which is really odd, is that the US government bonds actually performed worse than higher risk bonds. So when you buy bonds from the government, obviously it's backed by the full faith and credit of the US government, versus if you buy a corporate bond and you're buying one from a company, you have default risk. And when the companies are suffering because of their own situation and you're seeing that reflected in the stock market coming down, that's when you start to worry that there's going to be some default, because obviously companies are not being as profitable, they're suffering a little bit, and so you do wonder about that. So it's a little bit surprising that there was actually less volatility in long-term corporate bonds than there were long-term government bonds. Nothing too groundbreaking there, but again, just getting back to that, pretty significant downturn in the US bond market. This particular slide, really the only thing I want to kind of point to for this presentation is this is what the curve looked like at the end of 2021. So it was a normal curve, which means short-term bonds are paying more than, you're making less on a short-term bond and progressively more on intermediate and then more on a long-term bond. And you can see up here at the top that that's where we saw the inversion, where short-term bonds actually were paying more than long-term bonds, which nobody wants. It doesn't make sense. It's not a good kind of hierarchy to have that risk not manifest in return. So it is something that is always an issue that we have to pay attention to. So that's just, I wanted to make sure we kind of establish that data. There's nothing there that probably doesn't have some familiarity to you in terms of how things performed last year. Now the question is, what does this really mean? And are there any insights that we can take away? And how should we think about the markets? How should we think about the stock side of the markets in addition to the fixed income side? So I'm going to need to spend a little bit of time on every slide from here just because there is quite a bit of data on it. But what you're looking at here is we ended up with a year where we had both bad returns in stocks and bonds. And I alluded to the fact that how often does that happen? Do stocks and bonds typically perform different if one's up is the other down and vice versa? So what you see here is this quadrant right here on the bottom left is where 2022 was, and that was a year that was both negative for stocks and negative for bonds. Somewhat surprisingly, that only happens 11% of the time. So it's actually not the norm. You can see up here that the norm is good years for both. And because we think we own bonds so that we can have some what we call non-correlation to stocks where it's not moving in the same direction, that seems a little bit surprising to me. It's obviously a good piece of news that the vast majority of the time you're making money in bonds and stocks, which is confidence in long-term capital markets and being a disciplined investor. We can maintain that from the data as well. And then you'll see that 15% of the time it's positive for bonds and negative for stocks. And then the least amount of time that things happen is, or the least probability here is a negative return for bonds and a positive return for stocks. Okay, so I want to break that down and talk a little bit about why that is. You can see that not only was 2022 bad, but it was a bit of an outlier, really far down. And that's reflective of the data that I just presented earlier. But this right here, this negative for bonds, positive for stocks 6% of the time. I want to do a quick exercise to kind of talk through why that is. So, and many of you have seen this at some point or another, but this to me is the best way to understand how bonds work. Bonds have a price. And so in this example, we'll use $1,000. So if you buy the bond for the value that it's selling for $1,000. And you buy a bond that's 3%, you're going to get that 3% for as long as you hold that bond. And then if you, let's just say the maturity is 5 years, at the end of the 5-year period, you get your $1,000 back. Okay? That's the essence of holding a bond to maturity, is just receiving the income on an annual basis and then recouping all the principal that you put into it when the term is over. Okay? So as interest rates rise like they have last year, what that does is that creates a negative year for bonds because nobody wants to buy a bond that you have at 3% when they can go to the open market and buy a bond that's paying 5%. So you're going to sell at what's called a discount. Okay? So getting back to what that really means relative to this slide is the bottom right actually makes quite a bit of sense. And the reason that it makes sense is because if bonds have a bad year, that means interest rates are rising. And then there's a reciprocal impact of that on stocks. And what's the impact of stocks? Cost of capital has increased. So for years, coming out of 2008, the government bailed out debtors, punished savers by giving you basically no return on anything that's safe for the last 14 years. And then all of a sudden, when interest rates start to go up, the cost of borrowing money goes up. So companies that were able to borrow and just continue to grow and do everything they want with funds that were costing very little, now the cost of capital goes up. And because the cost of capital goes up, profits go down. So it's really quite normal that that quadrant exists, because it would be hard to imagine a time where bond prices have gone down because interest rates have gone up and somehow that didn't also have a negative impact on companies and their profit. So in order to understand this slide, so profit and earnings are synonymous terms. They effectively mean the same thing. And what you see here is earnings is a function of top line revenue, how much money all the companies that you invest in are bringing in, and then what that expense is. So I bring in $100,000 a year, I have $90,000 of expenses, I have a $10,000 profit. If I take that $10,000 back to the 100 grand that I made total, that's my profit margin. In that case, it's 10%. So what you see here is that this is the change in profit margin. So what that means is when companies as a whole are getting more profitable, what does the market do when companies are getting more profitable compared to what the market does when companies are trending in the opposite direction? And what that shows, it's not a perfect match, but you can see that this blue line is the trend of profit margin, earnings going up or down, and this gray line is the market. So you can see there's a relatively tight consistency between when companies are trending in a more profitable way, the market tends to do better. Okay? Not necessarily a big surprise, but it's a pretty tight correlation there. So how do you measure companies' profit, and what does that really mean? Well, in our world, we use something called a CAPE ratio. It's very similar to price-earnings ratio. But effectively, the question we're asking is, what is the level of profitability that you're paying for? So as those ratios go up, as an example, as PE ratios go up, what that indicates is you're now paying more for the stock. And if those continue to go up perpetually, what that really means to you is the question starts to need to be answered, am I overpaying for the market, right? And you've heard that a lot if you watch the financial media over the last handful of years, because as PE ratios have gone up, it's indicated that maybe the market is priced too high. And a lot of people have felt that and asked that question, should we continue, is now a good time? Is the market going to go through some down cycle? It doesn't go through arbitrary cycles of 7 years or 10 years. Right, getting back to that first slide, the market's going down because of all the uncertainty that's in the marketplace in general. But what this shows is that when inflation is high like it is right now, PE ratios come down. So if you think about what's causing pressure on corporate profits, what's causing pressure is their cost of capital has gone up because interest rates have gone up, so it costs more for them to borrow money, and inflation has gone up, so now that's also eating into profits. So what you see companies do, which is a healthy part of the market, is exactly what you're seeing right now. They're laying people off, they're finding a way to cut costs, they're removing dependency on foreign countries in certain circumstances that gives them no cost control. So all these things are what the companies are doing to put themselves in a better position relative to their profits. So this, again, it's just kind of reiterating the natural sequence of events that have happened and why it's what should happen. So as these come down, the government doesn't want us to be here, right? You see the market off today. I don't know where it is right now, but it was off pretty significantly because there's still this question of, is the Fed doing enough? Is it actually bringing inflation down as much as we need it to? And today the message that was sent was, no, it's not working enough, which effectively means the market is now worried that the Fed is going to continue to be more aggressive, to continue to be resilient in their pursuit of bringing inflation down, and that's going to effectively push us into a recession at some point. So if you look at the trend of this, the government, I don't believe the Fed is going to allow inflation to be high. They're ultra committed to changing this. As inflation comes back down, that reduces the expenses on companies, and so now you see the trend that I talked about earlier. This would be the trend. As it moves up this ladder, that is the trend of positive earnings margin, which we saw is correlated to increases in the market. So what we would argue to some degree is this is what has to happen for you not to buy stocks that are overvalued. Is we have to, in periods like this, when we see profit getting so high because companies can borrow for nothing and just continue to grow and grow and grow, that's not necessarily a healthy environment to be in. That sends inflation into a tailspin, and then the Fed now works to push us back that way. So that's a bullish sign, right? I don't know if that's 3 months from now, 6 months from now, 12 months from now, or whatever, 24 months from now. But the sign of companies' ratios coming down, them doing the things they should do, and then also simultaneously having the Fed address inflation would effectively be bullish for the markets, because when that reversed in the other direction, we expect the market to be better based on the historical data that I showed you. This one's a monster, but the scale on this is the bottom is the 10-year treasury. So the first, as it went backwards, was showing higher inflation to lower inflation, right? As inflation reduces. The message is the same here. When treasury yields are really high, interest rates are really high, companies tend to be low in their profit. So not only will the Fed moving inflation down send us to a historical trend of increased profits, which should bode well for the market. Also, I think it's safe to assume there's this incredible impatience when it comes to what the Fed is doing, right? We want the Fed to move interest rates on Friday and Monday CPI to come down. The problem with that is that's not the way it works. So what ends up happening is, how is the Fed going to get it right? And most people think the numbers are going to lag far enough that the Fed is going to feel so much pressure, they're going to go too far, and then ultimately that's going to push us into a recession, which would normalize interest rates again. The biggest reason why this interest rate environment is so different is because historically, when we've seen interest rate increases, that in general they've been a little bit more like this. This time they were like this. I mean, the increases have happened so fast in such a short period of time that it's even harder for the Fed to get it right, because they don't have any time to like kind of settle into the data, right? So both of those would be bullish from the perspective that if interest rates slow their pace of increase or potentially tick back a little bit, and if inflation gets under control, that's going to decrease expenses for businesses, which is going to increase profit margins, which historically has led to better markets. So this is just confidence in how we want to approach the markets. It's not, it's not a moment in time, unfortunately, but it is the trend that's expected and something that we should see as normal. This is what the market should be doing in a period like this, okay? So inflation is really high, and now it's interesting because when, you all know when we run your cash flow models, we put inflation or cost of living adjustment on that. We want to make sure that if you say you want to live on $100,000 today, that we forecast that that's going to need to be $200,000 in the future. And the evidence of how, as in general, as people were very myopic and we think about what's going on right now, is that a few years ago people weren't thinking about that at all. There was no real likelihood that inflation was going to stay as low as it's been for the last handful of years. But now when people come into the office, if I say we run a 3% inflation number, their kind of guttural reaction is that's not enough. Okay, so I believe it's enough for a bunch of reasons. One, I think that retirees are far less subject to inflation, and I've seen that manifest. I don't see people come into my office and say, I need 3% more than I did last year, and then the next year I need another 3%. I hardly ever see that, right? Where you guys spend money is when you take a big chunk of money to go do something fun, which I don't want to hear about right now. But what you're looking at right here is, this is the 10-year treasury, and that's the blue line, and the bottom line is TIPS, which stands for Treasury Inflation Protected Securities. What that means is they're bonds that when the interest rates go up, they go up with them. So that scenario that I wrote earlier on the board where interest rates go up and that pushes bond prices down, these protect you from that, okay? So, but the spread indicates how the market is forecasting inflation. The difference between those is what the market thinks inflation is going to be over the next 10 years. So when we hit a high mark on inflation and we look out the next 10 years, the market was expecting long-term inflation to be 2.8%. Now, more recently, in December of 2022, the market is projecting that the 10-year inflation will be 2.26. Okay? So if you again, I want you guys to kind of take the trend away. If you think about what I've said so far, this, again, says inflation won't stay this high, as defined by this relationship that has existed. If inflation is actually 2.2 over the next 10 years, that, getting back to that first slide where I had the bars on it that were kind of decreasing as inflation, or increasing as inflation was decreasing, we would expect that inflation is going to resume or revert back towards this mean. So I think there should be a relatively high confidence level that you'll see that reduce and you'll see the profit margins begin to increase for companies. So there's a lot on this, but that's really the stock side. Was that comfortable for everybody? Did that make sense? Or was that just so much data it's hard to even, you guys feel? I've seen some nods. So that's the stock side of the question, right? How do we think about the stock side? So again, what we think right now is we were fortunate that the premiums that we follow, the evidence from the University of Chicago that we follow, which is a probability, you guys are probably aware of that. It doesn't work all the time. It works a majority of the time. Those happened to work last year, several of them in a pretty meaningful way. So that continues to kind of suggest that these trends will continue, particularly value versus growth. It lagged for a few years there. And when that happens, people start to ask the question, is that gone? Is that ever going to come back? Particularly when tech companies are raging, everybody's like, maybe this historical value against growth scenario is not really going to continue. Well, when you have these things happen, it reminds you that we use 100 years of data for the things that we believe in so that we don't get too swayed by what happens in a year or two. Then I would want you to take away that this reaction that we've had is completely normal. And if you can bring it back to, I think, something that you guys all resonate with, because you've lived in an era where you felt like stock performance was a little more intuitive and rational, right? I hear a lot of times people talk about, well, how the heck is this company going up when it hasn't even shown any good numbers? Or, it's not like it used to be where you could just go see if the stock was a really good stock and that would define if it was going to do well. And I would argue that that profit margin trend, it suggests that you can. When companies are profitable, we can have some identification that that looks good for the markets. And what happens naturally is what we expect is those things come down. Now stocks go from being overvalued to fairly valued to potentially undervalued, which is a good thing for long-term investors if you, one, stay in your seat, and two, if you go ahead and allocate a little more to those things at the right time. On the bond side, there's also some questions here, right? What happens to bonds in times like this? And there are trends happening in bonds today too, one of which is short-term bonds are paying more than long-term bonds. And for the first time in a long time, you guys can put money in a savings account or a CD or a short-term government treasury and feel like, wow, I'm actually getting paid 3-4% for these investments now. So what that does is that consolidates everybody's attention on, why wouldn't I just go buy bonds in the really short term because I can make good money and they're paying more than long-term bonds. The problem with that logic is the short-term bonds will mature at some point, which means now you have cash into your investments and you have to figure out what to do with it. So at some point when the curve is no longer inverted and it's actually a normal curve, if you have to reinvest that money at that time, you may not make as much as if you had just bought long-term bonds in the first place, even though today there's a relative kind of risk of doing that because short-term bonds are paying better. It's not throw the baby out with the bathwater and just rush to nothing but short-term bonds. What you see here is after inflation peaks, 24 months after inflation peaks, that's the return of bonds over that time frame. So getting back all the way to the quadrants, if we think about those quadrants and the 68% of the time things are good for both, well, if we have interest rates moving in a direction against inflation and we have profits increasing for companies, the signs would point to we are moving towards that right quadrant eventually, because what this says is 11.7% return at 24 months after we've hit high inflation peaks. So when we've hit a peak inflation like we did last year, 24 months after that, the return in bonds has been pretty solid, right? 5.5%-ish over that 24-month period, annualized. Then the other thing is after rate hikes. So when the rate hikes kind of slow down, what does that mean for bonds historically? And you can see it's actually slightly better, 18.3%. So now if you put those two things together and you think about inflation and interest rates in the current environment as they relate to both stocks and bonds, in the not too distant future, history says that bodes well for the returns coming out of those periods of time. Does that all make sense? which leads us to kind of the central question that we started talking about last year, which I alluded to already, and that is what does the Fed do to make sure that they don't go too far and ultimately push us into recession? That's still the one remaining uncertainty in the market. We talk a lot about the fact that markets are forward-looking, and I think one of the last two guys said that economics looks backwards and markets look forward, which I think is a good paradigm to have when you evaluate economic information. So inflation, a lot of that in terms of the actual impact of inflation has been priced into the market, right? There was a bunch of drop in the market, the volatility happens because the market is saying, inflation's here, corporate profits are going to be lower, so we're going to start to correct the market and get things back to a more fairly priced environment, right? Does that make sense to everybody? So the geopolitical risk in Ukraine, I would say for the most part feels like it's been priced in. Nobody ever really knows, but that is another thing that feels like the market has, for the most part, priced that in. You don't see big gyrations in the market going on based on what's happening there at the moment. Obviously, if something escalated, and then that we have to reassess. But so the remaining outlier that's still not been addressed is what happens to markets during recessions. And really, for all this data, I don't necessarily know what the conclusion is going to be of the data. So I don't start the kind of thought process around this presentation of I got to convince my clients that the market's going to be good. So let me go extrapolate as much data as I can that supports that narrative, right? We pull all this data and then we say, okay, what does it say? And then what should the tone or the kind of message in the presentation be based on what we found in the data that we looked at? And so similarly to all that other stuff, recessions was the same thing for me in terms of what is the market performance like during recessions? Because obviously the fact that the market keeps correcting when we have more concern about the future of a recession means that you would think that returns are going to be really materially negative if we enter into a recession. But what you'll see there is this is the last 11 recessions, peak to trough. And what you'll see is the average return through those recessions is basically flat. For me, the first time I saw that, that was a bit surprising to me that the returns weren't more materially negative through periods where we were having a recession. And you do see, obviously, there's quite a bit of difference. There's some really big positive years. If you consider the S&P 500 as average 9.5 or 10%, then you can kind of assess how far those were from the long-term averages of the market. And really only one time was it close. Otherwise, it's pretty significantly on the positive or the negative side of the historical averages. So some of the things that I think are insightful about that, first of all, it means that you don't have to feel like if we go into a recession, you're guaranteed to have a bad year in the market. That's not something we can take away from this data. But one thing we can start to look at is what causes this right here, and why would some years be so high and some years be so low? And nobody really knows the answer, but one thing that kind of jumps out at you or comes out is, this also speaks to last time Apollo talked about what actually the definition of a recession is. It's not 3 or 2 quarters of negative GDP. This is one good proof statement from that, because we had a recession and it didn't even last a full quarter. So it can't be 2 quarters of negative GDP if we had a recession that was only a quarter long. So, but what you see here, if you use 2008 as an example, I would argue the economy was the reason that the market corrected in 2008, right? Big defaults on mortgages, foreclosures, right? These are all the economic conditions that cause people to get really scared about the market. And so in a pretty short period of time, you saw horrible economic information and it correlated very tightly with bad moves in the market. So the market didn't really have time to get ready for this, right? There are some people, who I guess had the foresight to say something's not right here, bundling all these bad loans. Like at some point we're going to pay the piper, and they may have had, either some position that was predicting that or just a thought that this is probably going to happen at some point. But for a lot of people, it was just kind of everything was sailing along. mortgages are getting, huge high volume of mortgages. People are buying homes, everything's going up, and then all of a sudden, boom, it just turned off very quickly. If you think about this particular scenario as an alternative to that, the market has had a lot of time to digest whether we're going into a recession or not. The market actually corrected because the economy was too good and we got to a high inflationary period of time. So what that really tells me is that we've had 12 to 18 months where the market has been digesting whether we're heading into a recession or not. And so we've already had at least some of it priced in. It's being priced in today, right? Because the inflation numbers come out bad. Investors think that means the Fed's going to be more aggressive. They're going to be too aggressive, put us into a recession. So we should start pricing that in now. And there is some correlation that in the years where things have been positive, the recession represents the end of the market downturn as opposed to something that kind of signifies the very beginning of the downturn. Again, as you know, I'll always caveat, nothing's a perfect match, so we don't know that for sure, but it would give some indication that the market is slowly digesting this downturn as opposed to having it hit all at once, which is a bit more similar to the years where returns haven't been so significantly negative through the recession period. Okay? The consistent piece is this here, right? 2001 is a bit of an outlier because we had two recessions to some degree because we had the tech bust and then we also had 9/11. But otherwise, average returns is almost double the long-term average of the market. So it just means you got to stay resilient, continue to buy into things that you think have a high probability over mid to long term to do well. And that doesn't mean that short-term market volatility causes us all a little heartburn. But I would argue the majority of the data we pulled does have a relatively optimistic, trajectory. We don't know when, but it's the optimism combined with the kind of understanding and logic that markets are doing what they should be doing. Okay? All right. So I feel like, that just gives you some insight. Up until this point, that gives you some insight into what's happened, right? And it gives you some insight into if any of those things, without being, subjective predictors of the market. We try to make sure everything, as much as we possibly can, is objective and doesn't have our opinion in it. So I think those things that you saw previously, they have the objective evaluation of what happened and what typically happens after those things that have happened happen. I feel like Yogi Bear. All right. So the Secure Act, there's a lot of stuff in the Secure Act. You guys know how this goes. They pass, giant bills that nobody reads, and there's a zillion things inside of them. The one in bold is really the one that pertains to you, and that's the change in the required minimum distribution age. So if you haven't already started taking them, you now get to wait till 73, and then if you don't take them before 2033, then you get to wait until 75 to take them. So the two things that I think are relevant to discuss about the Secure Act, and the impact to required minimum distributions is, first and foremost, they keep doing this at the final hour, right? So there's so many iterations of this, and you never know what's going to happen. And it's almost like they intentionally let it die down so nobody's talking about it anymore. And I would say for a while there was just no talk about it. So in the business, we were kind of like, maybe it's not going to happen. And then all of a sudden, boom! Just like the last time, they push it through at the very last minute, and we have to change the rules. And there's so much ambiguity about that. So what we see with this change in required minimum distribution age is there is this trend of slamming things in at the last minute that doesn't feel particularly good to me. But the other thing that's a concern is they continue to if you read about this, most of what you see is they're doing you a favor by moving the required minimum distribution age back. And we just want to make sure, and this dovetails pretty significantly into some of the things we want to do from a planning perspective in 2023. So when we have our sessions to sit down, we'll be talking through this because to me, it's just a further indication that what they're really trying to do is they're trying to eliminate you from taking the money out in the tax bracket that you're in, because you guys in this room, you are savers, you're not spenders. Very few of you will ever become big spenders. And so when you look at the income that you need to live on, right? Some of you tell me what you need to live on, and I wonder where you live, right? I look at my bills and I'm like, I don't know how they live on anything even close to that. So if the government has you take the money out, it's likely going to be in a lower tax bracket than your kids are going to be in, or your beneficiaries are going to be in, because of Secure Act 1, which eliminated the stretch provision. So it took IRAs and 401ks from being a really good wealth transfer vehicle and multi-generational vehicle to not being very good at that anymore. And now they have full liquidation within 10 years. So to me, the progressive move back, at some point, I wouldn't be surprised if they do away with required minimum distributions, just so that you can continue to keep this corpus growing and growing and growing, and then your beneficiaries take it out at a 40% tax bracket instead of you in the 12 or the 22 or 24% tax bracket. So that's the big concern for me there. What we're doing to kind of combat that is we'll be discussing with many of you an approach to Roth conversions. And this is not just a math problem, although we'll present you with a math problem portion of it, but you'll also have to decide how compelled you are to leave money, and whether you're willing to pay some taxes up front. But the more progressive this legislation continues to get, from my perspective, the more prudent it is to think about some of those tax planning techniques. And you have to do that relative to the tax brackets you're in. So what you'll see when we go through these with you is a deep dive into what's the optimal amounts to do, and then how much does it cumulatively save you in taxes, both in your lifetime and then upon your death when it's received. So you guys can expect a fair amount of that. You got time? Gary, I know we already tried this. You can't see it. Okay, perfect. All right. So I guess I could have spent a little more time on those slides. We moved pretty quick, but yeah, it's good. I saw some people nodding off, so I know that it's time to, it's either too hot or I'm not interesting enough. Don't tell me which one. Just a couple company updates. So like I said, we do have this new simulation tool that we'll be using, and those tools come out of WealthView. For what it's worth, we are going to make a push to get more and more adoption to the WealthView system. Obviously, if you're resistant to it, we're not going to force you to do anything you don't want to do. But every year, unfortunately, we lose a client or two. And when that happens, you get to kind of watch what happens to the estate. And I had one client that we lost this year who, for all intents and purposes, was pretty buttoned up. But watching her beneficiaries sort it out was, it's been really complicated to figure out where everything is. She died of a blood clot coming out of surgery, so there was no advance notice prep time. So everybody's trying to figure out what her passwords are, and who's the beneficiary of this, and how do we get access to this. By the way, if something ever happens to you or your spouse, tell your kids or any of your executors you should come to us first, because once the institutions know somebody's gone, they lock everything up, so you really have trouble getting information from them. But we want to try to continue to encourage that you have this tool that we think is pretty fantastic, loaded up with the information, who the beneficiaries are, who, kids, grandkids, wills, trusts, medical power of attorneys, financial power of attorneys, all those things. The second quarter speaker is going to be my estate attorney, Julie Ratner, who many of you have used, but she's going to do some updates on the estate planning and do a little bit more of a free-form, open-ended Q&A, so you guys can start thinking about all the questions you might have from that perspective. If you don't have that buttoned up, please get that buttoned up. Make sure that all of you should have a medical, financial power of attorney and a will. So if you don't have that, make sure you get it. A number of you have that, and you have a revocable trust. That's also something that a lot of you should consider if you don't have them already. So we're going to make a push to do that. There's a bunch of things that are kind of uploaded in your vault that are checklists and things that kind of give you best practices about how to use that stuff. So just some insight into that. many of you got to meet Will Brossman, one of our new servicing advisors. So, obviously, as we've done client advisory boards, which we're going to resume again post-COVID, we've heard feedback over the years that as we grow and we had a fair amount of no-shows today, but this event got full, and we've moved from a smaller venue because we don't have enough space. The concern becomes, when is the service level going to suffer from the growth? Candidly, I don't have intentions of stopping growth, but I have we have a responsibility to make sure as we do that we staff correctly and that we gain efficiencies. And so we've added Will on the servicing advisor position, so he'll be potentially reaching out and spending some time with you. And we'll continue to do that. I think you can expect to continue to see a few more folks added to the team before the end of the year. So, as an independent, we have great scale and scope through the relationships that we have. So we obviously are able to leverage all the resources that Charles Schwab has, and Steve Ostrink, the Chief Investment Officer, who spoke a few times, his investment committee and all the people they have. And for any of you that have insurance products, we have great depth in that resource. So it doesn't all have to be done here, but we'll make sure that we try to stay ahead of that curve. And obviously, if you feel like we're falling behind, please let us know. I'll deflect it, blame it on somebody else, and then try to fix it. All right. Let's see. I had a quick cheat sheet, which is all right. So the last one is I forgot already. YouTube channel. So we've been sending these things out through the recordings, and during COVID, I was doing them obviously virtual. So we were in kind of a webinar software, just hit the record button, send it out. But obviously there were some limitations to that. And so the last few we've been sending out just individually after the event, sending the recording, but that gets hard because people say I didn't get it, or maybe it's too big or whatever. So we've got through compliance our YouTube channel. So we'll be housing you guys have seen we have videographers in the back. So those will all get updated and uploaded to the YouTube channel a handful of days. What time constraint can I put you under, Todd? You'll have it, they'll be posted tomorrow. You'll get this back and have it ready for them tomorrow?
Yeah, what was your rating?
So, depending upon how fast he is, within a week or two, we'll get it edited and cleaned up and get it posted so you guys can see those things as well. And I think, short of the fact that we had not enough burritos that were meatless, I think otherwise we got it right. There's still plenty of burritos out there, and we had enough coffee, I think. So feeling like we made some big progress on that. So again, my expectation is, I don't want to set the expectation that I am going to break ground in every one of these meetings and have to go find some over-sensationalized topic to come in here and blow your mind. I think the first one you guys can expect is going to be similar to this year after year, where we'll do some recap, talk about how these things are trending. I'll try to use different data and so forth, but and then we'll just try to be consistent with those things that are important to you. You guys can give us suggestions, if there's topics. I know some people have talked about that a cybersecurity expert would be good to bring in and kind of teach little tips and how to make sure that you're protected. I know in my personal side, I don't handle our business side, that's Amy, but on my personal side, I heard a cybersecurity person, and the first thing out of his mouth was, don't have the same passwords for all your websites. And I was like, oh geez, this is gonna be a long day. But if there are topics that you think are either relative to your demographic in terms of things that are important, or financial, let me know. I also, maybe just since I have you guys, so many of you are traveling. One of the things we've been entertaining, and with all things that I'm entertaining, if my staff's probably like, don't go say that you're going to do something, because then we're going to have to go figure out how to do what you said we're ready to do. But would you guys be interested or willing to have like a travel forum of shared places and like postings where you say, hey, I went to this place and we stayed here and this was really great? I don't know if that would be something of interest, but I try to, through hearsay, tell all the stories. One of you comes in and tells me about a great trip that you took to Maui, and then somebody else says they're going to Maui, and I try to regurgitate what I think I heard where they should go and give them some half, baked story about what vacation place you went to. So that may be something that we'll be doing as well. So next one is May 16th, I believe. So just for a save the date, we already have the speaker, so the invitation will come out, and I don't think that'll change unless something major happens in the market where we feel like we've got to do some emergency information, okay? I told you it wasn't going to be as good as the last guy, but I hope it was informational and you guys had a good time out there. We'll be sticking around, so hopefully we get a chance to chat with you. Did you have a question? Exact client number, that's probably a better Amy question, but we're consistently growing at a pretty similar amount. So somewhere probably around 50 to 60 new clients a year, I would say is a reasonable number. So we're blessed, I'm blessed, my staff is incredible. So I feel very lucky to be in the situation that we're in. And to be honest, not that I need to butter you guys up, but you guys are just great people. So we are humbled by the fact that we get to hang out with you guys and learn about you and see that you've raised great families and have great values and do all the things that you guys have done. So again, congratulations to all of you for that. Go ahead.
You mentioned your YouTube channel for previous applications.
Yeah.
Is that on your website, or is it?
It'll go out in an email within the next week or two where you guys will have the address, and then we do have the last two already archived on it. So once this one gets done, we'll send a notice that this one is ready, and then you'll also have the other two to watch if you want to do that as well. Okay? Anything else? How you guys? Oh.
That's a Tuesday. Do you normally do Fridays? So the 19th?
Wait till we send out the date. Where's Amy when I need her? All right, you guys will have a wonderful afternoon. The sun shines back, so thank you.